Fundamental research operates as a funnel. Analysis begins with the macroeconomy, filters through the specific dynamics of an industry, and finally isolates the individual company. Macroeconomic and industry data dictate which sectors have the highest probability of success. However, company-specific analysis determines which individual asset within that sector is worth the capital. This creates the central paradox of research. To build a credible model of a company's future cash flows, an analyst must first validate a series of unquantifiable, subjective factors regarding human and structural integrity. If the underlying governance structure is flawed or the business model is unable to scale, the financial projections generated in a spreadsheet become mathematically useless. To address this, we have to evaluate the investable entity as a complete system built from first principles. We will build this entity across 4 distinct layers: the business model engine, the defensive perimeter protecting it, the management operators, and the governance guardrails. Analyzing the structural integrity of the corporate entity provides the necessary context to trust the financial numbers it eventually produces. The foundation of any entity is its business model. Gary Hamel observed that market competition is ultimately a conflict between business models, which determine how value is actually captured and retained. This model dictates the specific key performance indicators an analyst must track. For a bank, the focus is net interest margin. For a retailer, it is same-store sales. For telecom, it is average revenue per user. The ultimate test of any model's strength is its pricing power. Warren Buffett frames this as the ability to raise prices without losing market share to a competitor. If a business can do this, it possesses a structural advantage. Capital intensity also determines how efficiently a model scales. Some businesses require massive physical investment to grow, while others multiply output with only minor incremental inputs. Growth destroys shareholder value if it requires excessive capital. Robust pricing power is the mechanism that ensures revenue growth translates into actual wealth. High profitability inevitably attracts industry rivals, making a defensive perimeter, or economic moat, essential for long-term survival. This moat is typically built through product differentiation, network effects, or superior operational execution. Analysts evaluate this perimeter using the SWOT matrix, treated as an interactive system. The top row covers strengths and weaknesses, which are internal factors management controls. The bottom row identifies opportunities and threats, which are external conditions imposed by the environment. An analyst executes this by cross-referencing both rows to see if internal strengths are positioned to exploit specific external opportunities. Without a defensible perimeter, short-term profits are likely to be eroded by competitors. We now look at the humans running the system, the management team. This separation of duties creates agency risk. Shareholders own the company, but a separate group of executives manages the daily operations. To measure competency, analysts scrutinize the historical track records of these executives across different roles and varying economic cycles. One objective measure is the guidance versus delivery record, calculating how consistently management meets the financial targets they forecast to the public. Analysts also assess key man risk. A resilient organization uses formal succession planning to ensure it functions effectively, regardless of who is in the top seat. Even a superior business model will fail if the operators lack the skill to run it or prioritize their own compensation over shareholder returns. Corporate governance provides the guardrails that mitigate agency risk. In India, SEBI mandates board composition. If the chairman is an executive, if the stock falls, margin calls trigger forced share liquidation, causing a catastrophic collapse in the stock price. Governance and ownership structures serve as the ultimate safety brake for minority shareholders. The final layer of analysis evaluates how management interacts with the external risk environment. Reviewing historical credit rating changes provides insight into whether management is responsive to external feedback and proactive in fixing structural weaknesses. ESG serves as a commercial risk mitigator. It assesses exposure to long-term liabilities that traditional balance sheets often miss. Environmental compliance prevents regulatory shutdowns. Sound social policies reduce employee churn. And strong governance lowers the overall cost of capital. In India, the Business Responsibility and Sustainability Report, or BRSR, provides the standardized framework for tracking these risks. Ignoring these indicators can blind an analyst to existential threats that only become visible once the damage is irreversible. This architecture forms the investable entity. The core engine is protected by a moat, operated by skilled managers, and secured by governance guardrails. Qualitative analysis is the systematic mapping of operational, competitive, and agency risks. These qualitative findings directly drive the quantitative model. The strength of the business model and its moat provide the justification for projected revenue growth and margin stability. Similarly, the integrity of the governance shield determines the specific discount rate an analyst applies to future cash flows. Better governance reduces the perceived risk and the cost of capital. Qualitative factors provide the necessary blueprints that justify every input in a quantitative model. By the end of this process, the analyst has underwritten the integrity of the entire human and structural system responsible for generating the financial output.